Hi everyone, thanks for joining Jeff and I today. Today we're going to talk about a new initial public offering that came out on when? June 12th? So last week, SpaceX has been a huge hype all over the place. Opening up, I guess they were saying Charles Schwab announced that it was like the fifth most active day in the company in over 50 years. Huge.
Yeah, it was a very exciting IPO. It was very much anticipated, and there was no shortage of people who wanted to get a slice of the action, shall we say.
Yeah. So they actually came out with offering, I guess, raising about what, 85 billion. So it's a huge offer. A lot of people were attracted to it, probably because of reputation by Elon Musk and other things that we can get into. We did not purchase it that day, so why don't we discuss that?
Sure. Well, there's multiple reasons why we avoided this. I mean, one is the valuation is just it's insane. It's trading at 100 times revenue, and to put that into context, Alphabet, which is formerly known as Google, trades for about 10 times revenue. So it certainly trades at a very, very expensive valuation, and that's the Musk multiple, shall we say. But the bigger reason was because of the data that suggests buying newly issued stocks is usually a bad idea. We went back to look at the numbers to say, how do new offerings do 1 year after they start trading? And the numbers are, well, the numbers speak for themselves.
Yeah,
Of the 15 largest companies that went public since year 2000, if you look at the difference between the first opening price and what the price was at exactly 12 months later, it was down 12 of the 15 times.
right.
And the median loss was about 34% in the first
Mm.
year.
So out of, I guess, a group of stocks that we did look at the history of that, there were three that were positive after the 12 months.
Yeah, the
So,
Arm Holdings, Kraft Foods, and Snowflake. Those were the
yeah.
three that were up a year later. So I think it's a fair rule to say that if you're looking to buy an IPO within the first year, you want to make sure you're buying it at a price below what it first traded at when it opened
Right.
on day number one.
And
So,
they did, sorry, didn't they open it? The price was about, which is interesting in itself to look at the price fluctuation of an offer, a new offer. So it opened up about 135 per share.
well, that was the offer price, and then it
Yeah.
opened at 150. So the very first trade was 150, and
Okay.
then it climbed all the way to $225 a share just two trading days later. And from that high of $225, it has now dropped 30% to 160 as of today. We're recording
Yeah.
this on Tuesday. I have no idea where this will be, where this price will be when this goes live. But the stock was down 15% yesterday. So there's still
Yeah.
a lot of price discovery because it just came out, and
Yeah.
so you get tons of volatility at this point in a new security's life. So, yeah, I mean, we wouldn't participate in this. One, the valuation is very unappealing.
Yeah.
Actually, we should also go through some of the reasons why.
Yeah.
Yeah,
Why a IPO will sell off like
yeah,
that.
right. It's not just a coincidence. I mean, that the prices went down. We came up with three good reasons why we think usually the price is lower 12 months out. So, reason number one is that boards of privately listed companies want to go public and sell their shares to the public when conditions are favorable, right? I mean, if you're selling your company, you want to get the most advantageous price. So they look for good market conditions, investor optimism, rich valuation multiples, and all that is to say they look for animal spirits. So that's number one. People go public in very strong bull markets. Reason number two is because the early purchasers of a newly listed stock are concerned that they'll miss out if they don't buy it right away. So they suffer from FOMO. They want to get in before the stock takes off to brand new heights.
So it's like an enthusiastic buyer,
Mhm.
maybe based on the reputation of Elon Musk.
Yep, absolutely. But
Hmm.
then as a new publicly listed company starts to go through the realities of no longer being private, so they have to do regular quarterly conference calls with investors.
Hmm.
They have to put out quarterly reports. They have to adhere to black periods, blackout periods. All that tends to then weigh on the stock, and it comes back down to reality eventually. So that's reason number two. You get overly enthusiastic people getting in right at the beginning before
Right.
reality sets in. And then the third reason is that there's a lockup period. So when a
Hmm.
company goes public, its insiders, which include employees or the founder, they can't trade their stock right away. They have to wait for a certain period of time to lapse. So in the case of SpaceX, they're doing a staggered lockup period. The first set of people can sell their stock on June 29th. Those were the early investors. And then insiders can start to sell their stock on August the 11th.
Hmm.
So once you get to those dates, you have people that may want to sell their stock. If you've got a huge portion of your net worth tied up in SpaceX, you might want to be selling to, buy that big house you always wanted
Right.
or a fancy car. Or you just, think this is too good to be true. So why don't I just take my money and run?
Or
So those are,
diversification, right?
yeah, diversification.
Invest somewhere
Absolutely.
else. Yeah.
Yeah, absolutely. So those are three reasons why we think the stocks are often lower 1 year after they go public. So, I mean, if it's not obvious, we did not participate. We would never participate in an IPO because
Yeah.
normally what happens is if something's going public and you tell the trading desk you want an allocation, we might ask for 100,000 shares, and then they come back to you and they say, well, we have 5,000 because
Hmm.
if
That's,
the
yes, very true.
if
Yeah.
it's oversubscribed, they can only give you
Yeah.
so much. We actually have a client who wanted to participate in this. Guess how many shares she was given? One. She got one share. So
Yeah.
she got one share at $135. But then if she wants to sell this one share, she's got
Yeah.
to pay what, $10? So she's taking a 8% loss just to sell her one share. So
Right.
so we wouldn't do that because if we're going to buy a stock for somebody, we want to make it 3-4% of their
Worthwhile.
portfolio. And if we get an allocation of such a small number of shares, we don't want any stock to be 0.2% of a person's portfolio.
Right.
So we don't participate in that reason. But also just because the data says these stocks are normally lower 1 year out. So I'd rather let something trade for a year or so and then have a fresh look at it.
Yeah.
So we might have a look, but this really is not our kind of stock.
No.
So,
All right.
all right.
Great to talk to you.
Yep.
We'll chat
Likewise.
later.